Welcome to our online presentation. We are now going to discuss a unit standard 242555. This unit standard deals with develop a potential wealth preservation solution for an entity. Right, let me just introduce myself. I am Johan Klute. I am the Managing Director of Integrity Academy, and I've also developed the material content for this qualification, as well as the presentation that you will be looking at and that we will be discussing right now. So you are enrolled in our National Certificate in Wealth Management NQF Level 5. When attending a physical classroom presentation, the facilitator would use slides like this when discussing the content of the unit standard. In the classroom, you would take notes from the slides and transfer that onto your workbooks. It is important to note that you are not allowed to verbatim copy from the slides, but convert the information into your own words when completing your assignments. Now, just imagine if 30 people is watching this presentation, all 30 people is filling in their workbooks exactly the same, and our verification department at INSETA look at these books, the immediate reaction would be that it's all one person and other people have copied from that one person. So please, if you copy verbatim, it will be seen as plagiarism, which could disqualify you from the qualification. Our assessors must report plagiarism to the academic head of Integrity Academy, that's myself, and I will then either contact you or your line manager to take further action, or one of my staff will be in contact with you regarding the infringement that has taken place. So please stay away from copying directly. Please try and write it into your own words. Now, what is the purpose of this specific unit standard? Now, qualification is made up of various units or unit standards, and this unit standard is intended for learners who give financial advice, such as intermediaries, financial planners, product developers, trust officers, broker consultants, bankers, sales managers, key individuals, and attorneys. So you can see it's quite a wide array of people in our industry that can do this specific unit standard. The qualifying learner, once you finish with this unit standard, would be capable of determining the wealth preservation needs of an entity, develop a wealth preservation solution for that entity, apply knowledge of tax implications to a complex retirement planning scenario, and propose a wealth preservation solution. Right, your qualification is made up of three components. The one is elective component, the others is your core component, fundamental component. Now, the core and fundamental components are all compulsory components of a qualification, consisting of a certain amount of credits that you must do and that we cannot remove from the qualification. The elective unit standard allow providers to select a variety of electives that is linked to the qualification. A strategic selection of electives can then help the organization be more market competitive and responsive to the market needs. Electives are also based on the number of credits the qualification consists of and remain after the core and fundamentals have been included. So once the cores and fundamentals has been selected in the qualification, we can add elective unit standards, and so we can design a financial advisor qualification, or we can design a healthcare benefit qualification, or we can develop a corporate benefit qualification by selecting the specific unit standards that align with that specific qualification and or what the market and or your client wants to achieve through studying this qualification. Right, so the qualification then, the unit standard then consists of specific outcomes, and mostly there is about 4 outcomes per unit standard. Outcomes is what we want to achieve by the end of studying this specific unit standard. So the first outcome here is determining the wealth preservation needs of an entity. So first we need to establish what does our client want and what does our client have in place. And once we know that, we can move further to develop a plan for our client. Right now, the next step is that a specific outcome, under that outcome, you get what they call an assessment criteria. We abbreviate it to AC1. So there's assessment criteria 1, and there's sometimes 2 or 3 assessment criteria under every specific outcome. Now, the assessment criteria, like the specific outcome, forms part of the approved SACWA qualification document. So we copy the specific outcome verbatim from the SACWA qualification document and also the assessment criteria. And sometimes the assessment criteria sometimes confuse our students thinking, what on earth do we want here? The specific assessment criteria is reasonably clear. It asks the capital and income objectives of a client are analyzed with reference to liquidity and term. So we've now developed an activity, or we can develop a question, activity, a task. We can put a case study here, whatever, to explain what the assessment criteria is about and to test it against that assessment criteria. So we've asked you now in the activity to prepare a list of at least 5 capital objectives and at least 5 income objectives. And then we'll award, let's say, 5 for the capital, 5 for the income, and award you 10 marks for the question. Or we give you half a mark for each, and that will then give you 5 marks for the question. But please go and have a look at the mark allocation of the question or the activity, and if it's 10 marks, then make sure that you give me 5 capital objectives and 5 income objectives. If you don't, then obviously you'll score less. If you give me more than 5, the assessor will only mark the first 5, because sometimes people give us an array of answers, 5, 10, 15, and our assessors just can't mark everything. So we told them to mark the first 5. If the 6th, 7th is correct, but the first one was wrong, unfortunately, he will mark the first 5 and award marks according to that. So if we look at income objectives, the financial planner should consider the following. Number 1, determine whether the objectives is net or gross of income tax. If the objective, let's say the income need is 10,000, do the client want 10,000 after tax is deducted, or does that include the tax? So we must be clear on that, because tax doesn't have an effect on your income that you are getting out. How long should the income last? That's the term. For what period must we provide? Should the income be available during the lifetime of one person only, or is there a husband and a spouse and children involved? So if it's more than one person, obviously we need to provide more for each individual need. Should the income escalate? And if it should, what the annual escalation percentage should be? So that we need to discuss with the client. I'm going to come back on the escalation. The sources of available income, where does this money come from? The tax status should be considered. Remember, there's certain types of income are taxed differently. For instance, if you get rental income, you can deduct any expenses incurred against the renting out of a property. Let's say you had to fix some broken items in the property, fix roof tiles, repaint the house. All those expenses is deducted before you are taxed on the rental income. Then dividend income, there's a 20% dividend withholding tax. That's usually withheld by the company that issued the share and declared the dividend. So when you get the dividend income, it's usually after tax money that the client received, for example, are not based in the same way. So as I said, various incomes are taxed differently. The same with pension fund income. the income would be taxed at a average rate of tax that we have discussed in our tax module. Right, if we look further at income objectives, the annual escalation percentage of income is critically important. Now, escalation percentage means that your income every year will increase at a certain percentage, let's say 5%, 10%, whatever. But remember, the higher this escalation is, the more dangerous it becomes for the client, because the higher amount that you withdraw from your cash or your capital, the less your capital is going to become over time, and eventually you're going to deplete all your capital. So the advisor should consider whether the income will keep pace with inflation, outperform inflation, or if the value of the income will diminish when compared to inflation over a certain term. The term of income should be considered. For how long must this money be paid out? Determine whether the income is of a temporary or a permanent nature, and if temporary, how many years will the income be available? Income or lump sum objectives. What is the objectives of the client? How much do he need? That you'll usually establish by drafting a monthly budget, and from the budget you can then establish escalation. We've mentioned that a few times. Very, very important, because if that escalation is too high, you're going to run out of money. And then at what investment rate can you invest the money? So that was the income objectives. Let's have a look at the capital objectives. So you've got to determine the reason for the objectives supplied by the client. If the capital objectives should produce income, the income amount determined in the escalation must be determined. Additional income objectives like estate duty, executive fees, and tax on lump sums to ensure that there should be no unforeseen events such as death or disability that takes place for which there isn't funding available. The sources of the capital should be considered. Where does this money come from? Is it cash invested in a bank account? Is it cash in a stock exchange market account? Or is it on a fixed deposit? Or is it in a pension fund? Where is the capital? Will the capital be generated through insurance or through selling a property? Is it cash in hand? Is it corporate benefits like pension fund, retirement annuity benefits? Or will it come from a buy and sell agreement? That's where a person has a share in a company or part is in a company, and there's an agreement that if should anything happen, he get disabled, or should he die, that the company then, by way of the buy and sell agreement, will pay out a certain amount to him or to his spouse. What will the tax implications be, such as estate duty? I mean, that's currently 20%, and if your estate is above 15 million, it is 25%. Executive fees currently 3.5% plus the VAT of 15%. Your capital gains tax, currently the capital gains tax exemption per year is 40,000, and at death 300,000. Is there any tax on lump sums that you need to take in consideration? What amount is required by your client? Which liabilities will be settled with some of the capital? Let's say he's got a bond of, let's say, R1 million, of which there's an outstanding amount of, let's say, 500,000. Are you going to pay that 500,000 out of the capital, or are you going to pay it off on a monthly basis? And then again, what investment rate will you receive on the capital invested? Right, so that's activity 1. So let's have a look at activity 2. Here we're going to refer back to a case study of Mr. Snyman that's in the front of your workbook that I've provided you with. So please go and have a look at the capital and income provisions already made by him and what capital objectives he wants and points out to you. We will have the following capital available at retirement according to the case study. The future value of the portion of the small holdings proceeds to the value of about 1.925 million that he invests the balance after paying his debts. Now, he's got an outstanding amount on that small holding. The capital on his pension fund currently amounts to 4.8 million. and the retirement annuity fund proceeds amounts to 742,000. That's the full amount, not the 1/3. The other capital available is listed shares on the Johannesburg Stock Exchange to the value currently of 150,000, unit trust funds to the value of 120,000, and his current income provision. He's made no mention of any additional income provisions like rental income or etc., except for his current annual income that he's getting from the work that he's doing, which is 732,000 per annum. Plus, he's also receiving a traveling allowance of 54,000 per annum. Right, if we look at activity 3, if we refer back to Mr. Snyman's case study, provide upfront and point out the capital and income objectives of the client. After retirement, he requires an income of at least 50% of his final salary. And according to Mr. Snyman, he will need retirement capital, according to him, 7.9 million on date of retirement, which is at the age of 60. So we need to establish where did he get that 7.9 million and why 7.9 million, and go and do a plan for him. So let's look at activity 4. Refer back to the case study and point out to Mr. Snyman's requirements with regard to liquidity and the term of the investments. Now, investments, he would not like to invest his money in high-risk investments, but he prefer medium-risk investments. So here we've established his risk profile. He realizes that there are several risk factors in his estate that needs attention. His monthly cash flow position is relatively tight. He doesn't have a lot of monthly extra money in his budget. Should the cost of covering the various risks cause a shortfall in his monthly cash flow, he would like a portion of the amount available for investment to be invested in fixed interest earning investments to supplement his income, should that be necessary. Mr. Snyman will be retiring in 9 years' time. Therefore, the money from the investments must be available in order to do his retirement planning. Right, so that's the first assessment criteria that we've covered now, 4 activities under that. Let's have a look at assessment criteria number 2. The capital and income available to the client are analyzed with reference to term and tax. So now we need to go and do calculations and analyze what he has at the moment. So let's just have a look at calculate the after-tax return in the following cases. In question 1, we say the rate of return that he receives is 10% interest, which is taxed at 37%. Now the question is, how much does he get of the 10%? Because it sounds like a nice interest rate, but after tax is taken into consideration, we take the 10% minus the 37% tax rate, then it only leaves him with 6.3%. So suddenly the investment rate of 10% doesn't sound that great anymore. It's now dropped to 6.3 after tax. That's why I said tax is so important. If we look at a 12% interest rate, now to find a 12% interest rate on any investment at the moment, I think it's not really possible, but if you find it, well, great for you. Let's say his tax rate is 42%, which if you deduct in the 42% off the 12%, then it leaves him actually with a 6.96% interest that he earns on his investment. So you can see it's just about half that interest that he can earn because of the tax, that's involved. Now let's look at a more calculated scenario. Here we say he's got 100,000, he invested at 11%, and his tax rate is 27%. So 100,000 times 11% gives you 11,000 rands tax, and if you take off the 27%, then it leaves him with only 8,030 rand. So the 11,000 he got minus the tax reduces to 8,030. So, or if you work out what was the effective interest rate, 11 minus 27 leaves him with 8.03%. So if you multiply that straight with 100,000, then that will give you the 8,030 Rand. So you can do it either way around. You could first calculate what the effective percentage is after tax, which is 8.03, or you can first calculate it with 11% and then just deduct the 27% of that. This is typical sums that we might give you in the summative assessment. That's the exam that you write after the skills program. Right. If we look at activity one further to question number 4, we've now taken a 200,000, but this he invests at 9.5% in a tax-free investment. So if it's 200,000 times 9.5%, then it leaves him with 19,000 Rand in interest. Right. So let's move on to activity 2. And here we're going to now look at a case study. For this exercise, we'll assume that Mr. Snyman, our client, retired from his pension fund on the 1st of March 2023. Now, that could be any time in the tax year for the year 2023-2024 up till next year, February, as the values should stay the same during the tax year. His current fund value, the fund value is the total amount in his pension fund, is 5,250,000. Now, according to the pension fund rules, you can only withdraw 1/3 of that amount. If we work out the 1/3 amount, it works out to 1,750,000 that he can withdraw from the fund. Now, in the past, he paid money into his pension fund. Now, the rules only allow a certain percentage to be deducted for tax purposes. So 250,000 of his contribution to his pension fund did not qualify for the deduction under Section 11K. Now, Section 11 deals with deductions in the Income Tax Act, and K deals with pension fund deductions. Mr. Snyman previously also retired from a retirement annuity. This was way back in July of 2016. So that was taxed against the 2016-2017 tax year scales. He received a lump sum then of 1.4 million. Lump sum means it was the 1/3 portion from the RA in July of 2016, and again an amount of 100,000 of his contributions to the RA did not qualify as a deduction under Section 11N. Now you'll see the first one was K for pensions, and this one is N for the retirement annuity funds. Now we ask you to calculate the tax liability on the current lump sum, the current lump sum being that 1.750 million, plus then we need to take in consideration the 250 plus 100, which is a total of 350,000 that he did not qualify for as a deduction. So let me have a look on the next slide at the schematic diagram that I've drawn up to explain this. You'll notice that we've added the 1.4 million to block on the 31st of July 2016, as he previously retired from a retirement annuity and he paid tax on that. So we need to take that tax in consideration. The pension fund rules allow a maximum of 1/3 in lump sum. So therefore, the 5.250 million divided by 3 equals 1.750 million when he retired on the 1st of March 2023. So in this block in the blue there, I said excluded if he received it before these dates. Now, there were 2 dates for retirement benefit withdrawals. If it was before 1 October of 2007, then that amount will be counted as a 0, so you won't get taxed on the amounts that you withdrew before that date. And when you resign at your work and you make a withdrawal or a withdrawal benefit before the 1st of March 2009, that amount would also not be taken into account for a tax calculation. Now, if we look at his last withdrawal was in July of 2016, that falls after both those dates in 2007 and 2009, which means that that will apply to the retirement rate table because he retired from both those funds. So those were both retirement benefits, 1.4 million in 2016 and now 1.750 million in 1st of March of 2023. Now, we developed a calculation sheet for you at Integrity Academy to make it easy to follow the process and make sure that you do the calculation correctly. Right, so this calculation sheet consists of various blocks, block 1, block 2, block 3, block 4. I think there's a total of 6 blocks. Block 1, we fill in all your current tax lump sum benefits. Now, current is the money that he received now, which is the 1.750 million in that first line. And then we add all benefits that he received on or after 2007 and withdrawal benefits on or after 2009. Now, we know that he received a retirement annuity payout in July of 2016. So there we will add a 1.4 million and the aggregate total will then be 1.750 million plus the 1.4 million, which will give us 3,150,000. Then the next block deals with the deductions. That's under paragraph 5 and 6 of the second schedule of the Income Tax Act. Now, there's various deductions that is allowed. I've listed there 5 of them. The first one is own non-deductible contribution. Now, we know that he's had 250,000 pension fund and 100,000 retirement annuity amounts that he couldn't deduct. So that we're now going to deduct here, 350,000. The next one is transfer to pension, provident or preserver funds or retirement annuity. In terms of section 37D, when a person gets divorced, then money gets withdrawn earlier and transferred to a pension fund. So if that was the case, but in this instance, there's a 0 there. Amounts transferred to another fund that was taxable in terms of paragraph 2(1)(b), small 1b, and we haven't had anything here. He didn't say to us he transferred any money into another fund, so that's not applicable here. Then tax unclaimed benefits transferred to a preserver fund. That's a preservation fund. And then the last one is transfer to a fund from a government employee pension fund or parastatal if Formula C applies and there's less A in that formula. Now, we'll discuss this specific scenario also later, but that's a different calculation that one need to do according to the Formula C of the Income Tax Act. Right, so the total there is 350,000 that we deduct from the 3.150 million, and that leaves us with 2.8 million left that we need to take in consideration for tax calculation. Right, so on the next slide, we provide you there with the rate table for the retirement amount. And the rate table there is from 0 to 550. It was 500,000 shortly before this tax year. They increased it to 550. So the amount now is tax-free up to 550,000 with the 0 tax payable. Then the next scale is from 550 to 770,000. That they also increased from 700,000 to 770. So whatever exceeds 550,000 is then taxed at 18%. The next one is 770 to 1.155 million. And whatever exceeds 770,000 is then taxed at 27%. And that 39,600 is now carried over from the previous rate table of 550 to 770. And then on the next rate table, 1.155 million and above, they've now transferred both those 550 to 770 and 770 to 1155's tax onto this one. So it's 143,550, and anything that exceeds then the 1155 million is taxed at 36%. Now, the amount that we are working with is 2.8 million, which is exceeding the top amount there in the rate table. which means that we will now take the 2.8 million, we will deduct 1155 million. That will leave us with 1645 million. So whatever exceeds the 1155 million must then be taxed at 36%. So that works out to 592,200 Rand. Now we need to add the 143,550, which is the tax accumulated up to that point, plus the amount that exceed, which is the 592,200. That will then give us a taxable amount of 735,750. Right, so let's continue to the next slide. That's now block 4, where we now will reduce his tax with the amount that he already paid in 2016. So we add the 1.4 million in there. That's the aggregate lump sum that he received in the past. Now, let's say we don't have the tax table with us for that specific year, then we're going to use this year's tax table. So we won't get to a 100% accurate calculation because the tax rates and exemptions were different then. But this gives us an indication of more or less what the tax payable was then. So if we go to the next page, so it's a 1.4 million minus the top one there, which is 1155 million. That leaves us with 245,000. That multiplied at 36%. Now the rate has been 36% all through all these years since they started with this. And that leaves us with 88,200 Rand that he must pay in tax plus the 143,550 on the rate table. So that gives us a total of 231,750. So he more or less had to pay 231,750 in the past. We now go to block 6 and we add in there the amount currently payable minus the amount he paid in the past, which leaves us then with a current payment of about 504,000 Rand that he must pay now. So you can see that the 1.750 million that he received is not what he's going to get. He's going to get that minus 504,000 in tax that he must pay. So that's why I've said in the beginning, income tax and tax is very important to understand, because when you do planning for a client, you need to take in consideration the impact that tax has on the client. Let's move on to AC3, assessment criteria 3, where we will look at the risk profile of the client is compared to the risk profile of the current portfolio in terms of risk and return. Activity 1, you need to establish the risk tolerance of a client. Below is questions regarding risk when discussing the client's current portfolio and how we suggest he or she needs to invest his capital. Now, there's many risk profiles out there. I know in the unit trust profile book that you can also order and that we've also suggested from Impact, what is it, from the, but I've left the link for you on the website that you can order it from. It's not a very expensive book, but they've got a risk profile analysis in that book that you can use. Sometimes companies has got their own risk profile analysis that you can use. Right, let's look at question 1. Define risk as it impacts on the return of investment in your own words. So what is risk? Right, identifying which risks are worth taking is the key to successful asset management. Investors who have a feel for different types of investment risks are in the best position to quantify risk, balance the risk, or decide whether the risk is worth taking. Everyone understands that there are risks associated with high-yielding investments, namely the risk of something going wrong and losing one's investment. But there are also risks and related to very conservative investments, the risk that one will not make a real return, that one's wealth will gradually be eroded by inflation. So one always sit with a risk. Right, let's have a look at question number 2. How would you decrease risk? Provide at least 3 possible methods of decreasing the risk on an investment. Right, so number one, you can diversify by putting it in different types of investment vehicles. I mean, let's say you invest in Naspers and in Prosus. Now, that's not diversifying because they're basically the same and they react the same on the stock exchange. So you've got to go and invest in something different, like mining shares, which is totally different from a Naspers share. Um, so that's when you diversify. The risk inherent in a growth investment tend to decrease the longer the term is of the investment. So usually if you go for 7 years plus, you will smooth out your risk over time. Guarantees can also help with reducing risk. Right, if we look at the next question, risk is divided into 5 general used categories. Name and describe these categories. Now, this is a term for these 5 categories. There is various terms for these, but we are using this one. Conservative, being primary aim is capital protection with stable growth. Your cautious or prudent strategy is capital growth with stable growth. Moderate is capital growth with moderate fluctuations. Then you get your assertive or venturous sum style, which is high growth offshore distribution, and then aggressive, which is exceptional long-term growth, but you are comfortable with the fluctuations. Right, let's have a look at question 4. Complete the words in the following sentence by selecting or highlighting the correct words in brackets. Right, so I'm just going to read the answer here. An older investor approaching retirement will be less willing to assume risk compared to a younger investor who will be less risk adverse. Educated investors with a high level of knowledge of investment instruments tend to be more risk tolerant. Right, the next slide, we've got another question like this, where we say complete the question or the sentence by filling in the missing words. And we can use similar questions like this also in your final exam at the end of the skills program. The higher the guarantee on the investment, the lower the proceeds will be. A high risk investment promises the opportunity of high returns, but no guarantees even on the capital invested. So the higher the risk, the less guarantee there is. Right, let's have a look at activity 2. Take another look at Mr. Snyman's case study and give your opinion which regards to the client's current risk profile. Mr. Snyman currently holds shares in the JSE to a value of 150,000, but it's not clear from the case study in which asset classes he invested. Is it very risk-averse classes or is it more risky classes? That information, unfortunately, we don't have. He made mention that he would like to invest, he would not like to invest in high-risk investments, but instead invest in medium-risk investments. So we can assume that it's in a medium-risk type of investment. We can therefore deduct that there is a more moderate this in his approach and should advise him to invest in asset classes that are more moderate in style. Right, assessment criteria 4. The needs of a client are prioritized in terms of available provisions. Right, so we can't always cover all our needs, so we need to sometimes prioritize which ones we'll do first, which ones we'll do second, and so on. Right, so activity 1, during the discussion with Mr. Snyman, specific issues and needs surfaced. In order to assist him, you will need to prioritize the issues. He mentioned and explained to him which of them needs to be attended first, second, or third. Mr. Snyman pointed out to you the following issues and concerns. His position at retirement. His original idea was to sell his shares in Prolux IT Pty Limited at retirement so that the proceeds can supplement his retirement capital. He has since realized that he will not be able to do so, as retention of the shares is the only way to secure a career in the company for his son. He will retire in 9 years' time when he turns 60. So that funding there is possibly out of the way. Income tax. He is of the opinion that he pays far too much tax and is looking for advice on how to reduce his income tax liability. And then his will and testament, he is not sure whether he will have sufficient assets in his estate to secure an income for his wife after his death, should he bequeath the shares in Prolux Pty Limited to his son and provide an equal legacy for his daughter, because he can't just give her something and not give the daughter something. Then the estate duty and capital gains tax. He would like to know what the combined effect of these two taxes would be on his estate. Other areas that concerns him are the cost of medical treatment, his position on retirement, and his position should he become disabled. As far as investments is concerned, he would not like to invest his money in high risk investments, but prefer medium risk investments. He realizes that there are several risk factors in his estate that needs attention. His monthly cash flow position is relatively tight. Should the cost of covering the various risks cause a shortfall in his monthly cash flow, he would like a portion of the amount available for investments to be invested in fixed interest earning investments to supplement his income if necessary. Right, so let's have a look at what we could suggest for him. I would suggest that we address the issues as follow. Death and disability first, because they can occur at any time. Death can take place tomorrow. Disability, you run over the street, you get hit by a car, and you can't walk anymore. Secondly, the investment of the funds from the small holding. You can sell the small holding and realize cash that you can invest. Thirdly, the issue with regards to the medical provision, because one can also fall ill anytime and then you need that provision. And finally, planning at his retirement. So first, with regards to death and disability, we will need to redraft his will, provide sufficient life cover to provide an equivalent cash legacy to his spouse and daughter, and to provide an equal income for his spouse to maintain her current standard of living. Combined with the life cover, we can also add some disability cover amount as required. Secondly, I would attend to the investment of the amount available from the sale of the small holding in order to provide additional retirement provision. And thirdly, I will investigate possible medical schemes that we can suggest to provide for future medical treatment. And finally, I'll combine his estate duty, capital gains tax, and income tax calculation with his retirement plan and establish if there is any further need to provide capital to increase his retirement provision. Here, one can possibly look at an increase in his retirement savings in terms of his contributions to the pension fund and to the retirement annuity. Right, that concludes our session on specific outcome 1. The next session we will discuss specific outcome 2, where we will look at develop a wealth management or wealth preservation solution. Thank you for attending this part of the session. I'll see you then in the next session.